This man is a trading genius. He turned $1,600 into $350 million, and he proved that anyone could learn his strategy by training complete beginners to make $175 million. Sounds impossible, right? Well, meet Richard Dennis, the man who revolutionized trading forever. Richard Dennis wasn't just lucky. He developed a systematic approach that was so controversial, other traders called it unorthodox and criticized him relentlessly. Dennis believed that anyone could learn to trade if properly trained. His friend William Eckhart disagreed, claiming trading was pure talent. So Dennis launched an experiment that would become trading legend. He recruited 23 people from completely different backgrounds: clerks, musicians, chess players, ordinary folks with zero trading experience. He called them his turtle traders. After 4 years of training, these beginners generated $175 million in profits. Dennis had proven his point. Discipline beats talent every single time. But how did he do it? Dennis built his strategy on 4 unshakable principles. First, risk only 2% of your account per trade. Second, cut your losses quickly. Third, let your profits run. Fourth, trade trends, not predictions. Here's what separates professionals from everyone else. Dennis expected to lose on most trades, but when trades went right, he'd let them run for weeks or even months. That's what made it wildly profitable. Think about it. You can lose 1% on 9 trades and make 25% on the 10th trade. You're still up big time. Now, let me show you Dennis's exact price action strategy that created these results. Step 1. Add the highest high, lowest low indicator set to 20 periods. This shows you key structural levels where price has bounced before. Step 2. Add the average true range indicator, also set to 20 periods with SMA smoothing. This measures market volatility. Step 3. Adjust the moving average in the highest high and lowest low indicator to a 200 period. This tells you the overall trend direction. Here's how it works in practice. You're looking for breakouts from previous high points, but only in the direction of the main trend. When price breaks above a previous high, that's your entry signal. But here's the crucial part, your stop loss. Take the ATR value, multiply it by 2, then subtract that from your entry point. This gives you a mathematically based stop loss that adapts to market volatility. Before we dive into examples, remember this: accurate data is everything in trading. You can have the perfect strategy and discipline, but if your broker feeds you bad data or has poor execution, you're already behind. Our team spent months testing top brokers for data accuracy, execution speed, and reliability. Check the link below to compare them side by side and find the best fit for your trading style. Now, with that foundation in place, let's see how Dennis's strategy actually works in practice. Price breaks above the previous high. That's our entry. The ATR shows volatility at around 10 points. Multiply by 2, we get 20 points. Our stop loss go 20 points below our entry. In this case, we might get stopped out on the first attempt. That's expected. Remember, most trades lose, but we keep following the system. Here comes another breakout attempt. Same process. Entry on the break, stop loss 2 ATR below. This time, price keeps running upward for weeks. Look at the math. We lost small amounts on the first trade, maybe 2% total, but this winning trade gives us 15% profit. We're up 13% following Dennis's exact system. Here's what Dennis understood that most traders miss. Humans hate losing. Even small controlled losses. We want to be right all the time. But Dennis trained his students to think mathematically, not emotionally. Small losses are the cost of doing business. One big winner pays for multiple small losers. The turtle traders succeeded because they learned to execute this system with robot-like precision. Dennis used different setups for different time frames. On shorter time frames, like hourly charts, he stuck with 20-period settings. But for daily and weekly charts, he increased the structural level detection to 55 periods. This gave cleaner signals on larger time frames and reduced false breakouts. Richard Dennis proved that successful trading isn't about being a genius or having special talent. It's about having a systematic approach, proper risk management, and the discipline to execute consistently. If this strategy opened your eyes to a new way of thinking about trading, smash that subscribe button and let me know in the comments.